Go look at the products that have had 0 sales in the last 30 days against what percentage of your balance sheet in terms of your inventory account they make up. We see a lot of merchants that discount their hero products way too heavily and don't discount their kind of C grade products at all, or not heavily enough. It comes back to merchandising, it comes back to discount strategy. But these like flat discounts where you're willing to offer the same discount on like literally your best products, the hero products, versus the products that are already unpopular, no one's buying, whether it's an acquisition SKU or a retention SKU, how you treat it, how you merchandise it, how you discount it, it all matters. Liam, how's it going this morning?
Not too bad. I'm pumped to talk about product strategy and kind of dive into that. I think it's something that's going to be an interesting one to chat more about.
100%. So this topic was actually your idea, and it's a great one to chat through because I think it's, you know, we talk all day about what we can do on the ad side, what we can do on the financial modeling side, what we can do on the retention side. I think that the kind of link between all of those is the fact that there's an underlying product strategy that makes all of this, you know, even worth talking about. So I think today we want to spend a little bit of time talking about what product strategy actually means and what it looks like. And we want to bifurcate the conversation into thinking about it from an acquisition perspective and a retention perspective. So we at Aplo think of products as acquisition SKUs and retention SKUs, and we'll get into what that means. But before we do, maybe Liam, if you can paint us a picture, when you're talking to 8-figure brands across CPG, clothing, and apparel, how do they typically think about product strategy?
I think the first thing you said there about acquisition and retention products is definitely one of the key things that when I speak to brands that really have a grasp on D2C and what it takes to win in this space, they understand that there's different sides to products. It's not just this is a product I'm launching, this is an acquisition product, or this is a retention product I'm launching. They understand the use cases for both. And they also understand that like the speed at which you can test and iterate and launch products and de-risk launching products to actually test it is how you actually win. Because at the end of the day, like acquisition strategy is important, retention strategy is important, creative is important, all of that moves the needle. But the biggest thing is the actual product. Like that's what people are buying. That's what gets people to come back. That's what actually builds your brand, is whatever you're selling or whatever you're talking about. So I think most of the most competent D2C operators in the space understand that, and they really focus on actually mapping out strategies for both the acquisition and retention side from a product launch standpoint.
That's such a good point. And it's so obvious, but there's so much noise that we can actually forget that it really comes back to product, right? Like at the end of the day, that's what you're selling, a physical good of some sort. So I guess let's unpack what this acquisition versus retention strategy, SKU strategy means. You know, an acquisition product, what would you define an acquisition product as, and how should brands think about acquisition SKUs? So
there's two ways I think that is probably worth looking at acquisition products. Firstly is like obviously what actually works on acquisition, what gets people in the door. But a bigger question, a bigger kind of, I don't want to say issue, but a bigger question mark on the actual acquisition side is like, is the product actually high enough margin to give you the ability to actually scale it on acquisition if it's the thing that's feeding the new customer acquisition side of your business? I think that's very important. Obviously, making sure that whatever your acquisition products are, that you're building it in a way where it actually has the margin profile that is suitable to be an acquisition product in the first place, and to put heavy spend behind it when you're probably not going to be actually having, you know, that much margin on the acquisition to begin with. So I think that's something that on the acquisition side at least is important to look at. And then obviously secondly is just what is something that people are actually coming in on first order more often than not. So those are two ways I would think to look at it. I'm not sure how you'd think about that, Jacob, but I think that's something that I've discussed with a lot of operators in the space. That's how they obviously look at the acquisition side as well.
100%. I'd love to jump more into contribution margin, because the other way to thinking about it is, do you have, like, how predictable is your lifetime value? Because there's always that offset, right? Where it's like, if you're, for lack of a better term, if you have bad margins on a product that works on acquisition, for example, can you make that up in cumulative sort of dollars later? Yeah. But that can be a very risky strategy. So, you know, what degree of confidence are you kind of underwriting that LTV against, right? Like, is there some sort of proven strategy here where you can actually potentially acquire at break even or even at slight loss and still see those cumulative dollars come back to you? Or, to your point, does your acquisition product need to be something that is high margin? I was talking to a brand a few years ago. They were in the men's kind of like the men's health and wellness space, let's say. And they had a hero product that was profitable on first order. And I'm not going to call out the brand, but they were scaling quite aggressively. They were very large, very successful, and first order profitable. So making very good contribution margin on first order, and basically scaling purely from an acquisition perspective. But they had one product, just one, and an entire catalog of potential repeat products that they had not introduced whatsoever. And the discussion was around, okay, well, you have this one product. It's clearly working on ads. You can clearly scale it, and you have no problem acquiring new customers. But once you acquire that new customer, first of all, the product was so great that once the person bought it once, they'd never have to go buy it again. And that just speaks to the quality of the product, right? It was just an amazing product. It wouldn't break, like you wouldn't have to go buy it again. And the whole point was that if you bought this product, you would basically have it for life. So of course, that's amazing. But there's no LTV component built into that product strategy, meaning once someone's bought it, there was no other catalog that they can complement that product with. So the discussion was, well, sure, you could scale on the acquisition side. This is clearly a proven acquisition strategy, an acquisition product, an acquisition SKU, whatever you want to call it. But there's no retention potential with anyone you acquire, which means a few things. One, it means that you're entirely dependent on your acquisition strategy working forever, right? So it means that there's no room for any variability in what your customer acquisition costs are, in what your actual like unit economics are. Obviously over time, like you would hope that your unit economics can get better, et cetera. But basically, if your new customer acquisition model breaks, your entire business breaks because there's no way to monetize on the back end any of the customers that you've acquired. So you're building up this really, really great base of customers who love your product, by the way, because their reviews were amazing. The satisfaction was great. Again, this product was super like durable, reliable, like nobody would ever complain about it. And it would last you literally like a lifetime. I'm pretty sure they had a lifetime guarantee if I remember correctly. So what they ended up doing was actually pivoting to introduce a whole new line of products that without this first product wouldn't actually make sense, right? Like you wouldn't buy, for example, let's say the product was a razor. Yeah. Let's just say that that's the product. Well, you can't really buy shaving cream if you don't have the razor already. You know what I mean? So it's kind of having a monetization strategy that you can actually encourage some repeat purchase behavior. And that not only helps during acquisition when you have kind of variability, because you have some expected repeat behavior, which is generally higher margin because there's no CAC associated with it. Your contribution margin is typically higher. And again, it introduces some predictability that maybe doesn't come with an acquisition only model. Because again, like any variability in your acquisition strategy, it completely impacts what your bottom line looks like for that month, that quarter, that year. Whereas if you have some padding, so to speak, on the returning customer side, that can actually help not only create buffer when you still want to scale and acquire new customers at potentially worse margins than you maybe want to. And it also builds in strategy for having incremental value over time from customers that you're acquiring. So I want to get your take, Liam, on that side, because I think that's a really common place that this discussion often goes is like, okay, you've nailed the acquisition side. Clearly your product's working. People love it. But there's no monetization strategy on the back end. And that hurts the overall revenue profile, profitability profile of business. So how do you think about that?
I think you explained it really well there. And I think it's something that, like, the way you framed it, where you have a product that is driving acquisition, that is something that might be something you don't need to replenish. Obviously, in the e-commerce space, we talk a lot about lifetime value. Replenishable products are fantastic because it allows you to actually have more value driven from a customer after you've acquired them over a long period of time. And the business generally is easier to scale. But with what you're saying is an interesting thing as well, where it's like those retention products don't have to be net new products entirely. They can also complement the acquisition product in this case. And that's also something that I think often does get overlooked as well when it comes to product strategy, is figuring out how you actually develop retention products that complement the product that people are actually coming in on, not necessarily just developing net new products that you think people are going to like after they come into your business because they bought product A. So I think that's an important way to frame it and look at it, the way that you just went through, how you went through it there. Because you really just, like, if somebody's coming in on this product and you know that there's other things that complement it, then you should really probably try that on the retention side, as opposed to trying like a brand new winner that you think is going to be another product entirely that they think that they want to purchase. So I think that's also like, you kind of get into like risk adjusted returns when it comes to product launches and developing product. I think like when you look at it that way, the way you framed it on the retention side, that's definitely a way to de-risk the actual risk associated with launching a new product. So yeah, I fully agree with what you said. I think it's a great way to kind of frame it.
basically that product affinity, right? And this is something that we were looking at 4 or 5 years ago at this point. I remember this discussion very closely, and specifically with our clothing and apparel brands. Let's say you, again, using clothing and apparel, let's just say generic, you've got your shirts, your hoodies, your hats, or headwear, whatever you want to call it. And you want to understand what the complementary set of SKUs is from an acquisition perspective, all the way through an LTV perspective. Are we able to cross-pollinate across categories, for example? You know, are customers who are buying shirts also buying hoodies, also buying headwear? Are they just buying more of the category that they've entered through? So doing these product affinity maps, especially in, well, it works in every single category, but clothing and apparel is the one that always comes to mind for me, because everyone always talks about cross-sell, right? We always have this discussion with brands, like, should we be cross-selling across categories? You know, the person who bought the hat, should we try to sell them the t-shirt, or the other way around, right? And the reality is, like, well, maybe we should actually just try to sell them more hats. You know, they've clearly shown intent. They're clearly interested in that category. And then that informs a whole set of strategies on the email side and on the retention side, where a lot of this kind of post-purchase behavior is driven. Because what you're really trying to do is encourage something that's already kind of organically taking place and just eliminate as much friction as possible. So if you already know that the hat purchaser is more likely to just purchase another hat, well, then tailor your post-purchase experience to actually just get them closer to the hat recommendations that would best complement whatever hat they made their first purchase with. And that can be done for any category. I think the same is true when you look at CPG and flavors, right? Things of that sort.
I think you hit on something that's really, like, really interesting there, which is that oftentimes what people are interested in buying after they bought product A is just the same product, whether it's a different variation or just literally the same product. That's something that you see time and time again, where people, like, as a hat, for example, a hat, obviously if they're buying a hat, chances are they'll probably want to buy another hat because people like wearing different hats. So it's like, don't overcomplicate it. Just kind of go to the basics first and think, okay, if somebody's buying this, they've shown intent in it, that means they actually have interest in this product. Maybe we try and get them to buy more of this specific product before overcomplicating it. So I think that's interesting. I think one thing I'd love to get your take on, Jacob, too, and I think you might have this on the list of kind of topics here to discuss, but is like the frequency of testing new product. Because I think if you look at a lot of the best brands that we work with and the best brands that we've talked to over time, and by best, I just mean like the ones that are actually like scaling the most aggressively, sustainably, and like actually are like keeping that year-over-year growth or quarter-over-quarter growth relatively consistent without having big swings. It often comes down a lot of times to how quickly they're testing product and what that product development pipeline looks like and how they've actually kind of like quote unquote operationalized launching new products. So I'd love to get your take on kind of that whole discussion. And I think this is something also that Dylan and John are being one of our partners at Free to Grow CFO. They talked about it too on the last podcast. They had some great takes. Yeah, we'd just love to kind of maybe open up the discussion there, because I think it's a very important piece of just scaling in D2C that doesn't get enough discussion. You go to a lot of conferences, you go to a lot of, discussions in the space. They don't often hit on the frequency of testing new product and what that actual like product testing pipeline looks like. It often gets overlooked. At least I don't seem to be hearing that too much. So I'd love your take on it.
For sure. So many ways we can go in this direction. So I'll try to kind of bring it all together. You touched on something really key, like a few minutes ago, when you said risk-adjusted returns in the context of testing new products. It's every net new product launch is a test. It's a bet you're placing. So there's a lot of kind of ways you want to mitigate risk, knowing that you're probably going to have to write most of these bets off to zero. But in the process, you're actually going to get an outcome that may be the thing that creates new momentum, new category, etc. So I'll go back to clothing and apparel, but this is analogous to virtually any, like, whether it's CPG, whether it's kind of consumer goods, health, wellness, like pick the category, but clothing and apparel, let's just stick with that one for now. If you're launching, let's say you have a line of basics and maybe you're just trying to launch new colors from your basics collection, you probably want to test with very small batches first and test through your retention base. Yep. And obviously you want to also see if this product can stand on its own too, from an acquisition perspective. So you don't want to necessarily not make it available to everyone to purchase, but a good place to kind of go and test initially is, okay, like if we do a relatively small PO, as small as you can, honestly, for some of these initial launches, can you see if there is a chance of this product actually standing on its own, so to speak, and being something that you can at least sell to existing customers? Now, again, this goes back to retention and acquisition SKUs. just because it may work on the retention side doesn't necessarily mean that this product can stand up on its own as an acquisition SKU.
Exactly.
But there are so many things you can do to de-risk that bet. For example, minimizing PO sizing. Number one thing. If you can do it, there's no point taking a bigger swing than you have to on something unproven. Because to your point, frequency is better than size at this point. You will place the big PO once this thing is proven, and we can discuss what those KPIs mean for proven. But you're better off having a higher frequency of testing. It also, frankly, just gives you more reasons to email people or text people, because at the end of the day, the more frequently you're launching products, the more reasons you have to kind of reapproach your customers with something that's genuinely new. There's nothing worse than texting or emailing your customer the exact same offer every single week, every single day, and expecting some sort of new behavior to take place. Like, sometimes that'll work. That's okay. If your catalog is big enough and the offer speaks for itself, sure, that may actually work. But again, you only get to a big catalog by also testing new products. So again, frequency, back to your point, right? So that's one way to de-risk. Limit the sizing. The second way to de-risk it is give yourself an opportunity to test it. If it actually doesn't pan out, there are ways to move that inventory, even if it's not at the margin that you originally thought you could move it at. Bundle it with other products, exactly. Merchandise your site properly. Exactly. Like, do you have sort of an evergreen sale collection where the products that you had tested this quarter, this season, just basically go to, like, whenever I see a sale collection, basically, where you have the highly, highly discounted stuff, think of that as basically losing products. Like, those are the products that just lost. The bet was lost. You want to get them off your books. You want to get as much working capital out of them as possible, but ideally as quickly as possible, so you can go and reinvest in the next bet. Because it's all a hits game. Like, you're not going to hit every single one, but every once in a while, you will hit something that will end up becoming part of that hero category, or at least it'll make its way from just the C grade inventory into B or A. So again, a lot of ways that once you've placed that bet, you can kind of again de-risk it, or at least cut your losses on it. And I think that frequency, again, like it has to happen on, like, it kind of goes back to how much working capital you have to actually go and place these POs. You know, what your relationship looks like there, what your product development process looks like what is realistic for you to actually like launch new products. But those are the KPIs I kind of look at, or at least how to mentally frame the process of launching new products.
Yeah.
If you can launch multiple products per quarter, I think that's a really healthy place to be in. If you're a low kind of to mid 8-figure brand, if you're in certain categories like clothing and apparel, you probably want that rate to be higher.
Yeah.
And the reason is because you might just expect more losses in the process. But again, you also don't want to be tying up too much working capital in brand new bets when you can double down on the stuff that's working.
Just going back to one that you said at the start of your point there, one of the like most important things I think from kind of a de-risking standpoint to focus on is you mentioned testing it with your existing customers. So we'll call that through retention channels like, you know, email, SMS, direct mail, even things like that. But just because it's working as a retention product there doesn't mean it's going to necessarily work on acquisition. So before you go place a massive PO and say, hey, my customers are buying this product on retention, let's like really go for it. If your intention with that product is for it to be used on the acquisition side, or at least just to get a feeler of if it actually can be an acquisition product, try that before you actually place a massive PO on it. And there's kind of levels to it, right? Like, okay, let's try it on the retention side with existing customers. Let's see how they react. Okay, if it's positive, let's put a little bit of spend behind something like this on acquisition to see if there's actually something on the acquisition side. If there's not, and that's not hitting, okay, maybe then this product is going to lend itself a little bit more to our existing customers. So maybe let's not go in as heavily, for example, on this product in the beginning, because it's not going to be something that moves a ton of units on acquisition. So like, kind of there's like stepping stones, I think, in that process, which is really important to hit on that you mentioned. And then the other thing, and this reminded me, I'm forgetting the brand off the top of my head, big brand in the CPG space. I'll come back to the name of the brand, but, and this isn't like a hidden strategy or something. They're very public about this, but I think one thing that this brand has done really well when it comes to to testing products, it's genius, is they have a VIP club where essentially people pay to actually be part of that VIP club. They gate it so there's only a certain amount of people that they actually let into it. So the exclusivity piece of it is there. And once you're in that club, you're basically paying a subscription to test new products for this brand on a monthly basis and to give feedback to the brand. So what this brand has done is they basically completely de-risked the product testing, maybe not entirely, but the majority of the actual like financial side of actually testing new products. They basically brought that down to zero because they have people paying in to actually test the new products that they're releasing. And if they give feedback, and then because it's an exclusive club, these customers are happy to give feedback, and most of them always give feedback because they've paid to actually be in this club in the first place to test products. So they're actually getting paid by customers to test products, which I think is like, if you talk about operationalizing the product testing and launching side of the business, that is like the holy grail of how to do that. I think it's fantastic. And obviously there's only like, that doesn't work for every single industry. It's not like that'll necessarily work for clothing and apparel because it's not consumable. Like, you know, you could do that, but do people really want to receive like new clothes every single month from a brand just for the sake of saying if it's good or bad and they're paying for that? Maybe not. If it's something where it's like consumable, people actually get to enjoy it and taste it and like experience it, maybe that's something they're willing to pay for. So, and I'm not saying it can't work in clothing and apparel, but there's certain industries where it probably works better. But to me, that's like the best example of really figuring out how to actually de-risk and operationalize the whole product testing side of things.
And like that's pure profit for the most part, right? The membership side. So you're de-risking a lot of things because you're just adding, well, you're adding. So it is a really great strategy for a lot of reasons, right? Like everything you just mentioned, plus all the financial leverage it gives you, because you're creating basically pure profit. You have this recurring kind of revenue in your business now, which there's like recurring and reoccurring, right? Like you might have a great LTV with customers and you can expect certain number of purchases within a year for every customer you acquire. That's really great proven reoccurring revenue. But recurring revenue, like membership revenue, where just like every month you can expect that this subscriber is going to pay to have this exclusive kind of access to that group. That's that introduces a level of predictability on super high gross margin revenue it's really hard to come by in any other sort of model. So completely agree. Like that's a fantastic strategy.
Yeah.
I think also going back to it. Yes, like it's great. And we've actually seen that True Classic has tried that in the clothing and apparel space. I think they've been pretty public about what their membership strategies look like there. So I think that's a good example of where it can work outside of CPG. But I do tend to agree. Like I don't think that especially for myself, like I don't think the membership piece appeals a whole lot in clothing and apparel. But at the same time too, like I think maybe it's a brand affinity thing too. Like, so it's not to say that can't work. You made a really good point too about the product testing piece, where if it doesn't work on the acquisition side, but it works on the retention side, what do you do with that product? You can always just choose not to reorder it, right?
Exactly.
And like that's the other thing where like it really helps to have a bucket of customers that you can actually sell, products to in the form of repeat customers, because not only are you de-risking, but you're able to actually like take a lot of this working capital that's just stuck and makes no sense to try to move on the ad side or on the new customer side and just, free it up. You can basically mark it down to as low as you want, at least get the cash back out of the products. And you can't really do that if you're only looking at the new customer side. Exactly. So sometimes it's not necessarily like, yes, it could be a failed product as in you don't go and reorder, but that doesn't necessarily mean that it's a failed launch, so to speak. You actually did exactly what you wanted to. You placed a bet. It didn't land as a winning kind of hero product, so to speak, but it doesn't matter because the bet still went in your favor, as in you still were able to kind of recoup some sort of return on that capital that you invested into that launch. And again, it all comes down to like, did you recoup it at the contribution margin you wanted to? Did you have to end up highly discounting it, et cetera? But I think that's the game, because the trade-off is you sit with products that you never kind of iterate on, and it works until it doesn't, and you don't really have a recourse after that. And again, if you're really stuck with only products that work on the acquisition side, it's great for acquiring new customers, but again, you have none of that revenue coming from repeat customers, none of that LTV. And that's a much riskier place to be in as a brand, because you're so dependent on only one source of revenue, which is basically, how are my meta ads doing this particular month?
100%. And one thing too that I think often doesn't really get discussed is, how should I frame it? Almost like the attachment to products that are being developed, like as an operator of a brand, a founder of a brand. Like oftentimes, in many cases, you're building something you're very passionate about, whether that, like whatever it is you're developing, the product is channeling whatever you're passionate about. And so there's like an ethos of the brand that's kind of brought to life through the products and like the way you talk about the products and whatever you're trying to create for the customers in that space. The reality of it is that most product launches will likely fail, and new products that you develop will likely fail. Like it's very hard to find winners. If it was easy to find winners, you'd see every single brand just crushing it and there'd be tons of brands everywhere scaling. It's just hard. It's hard to find things that are really, really big winners on acquisition and even on retention. So I think another key thing is just not to get too emotionally attached to the products that you're developing. And more so, I think I would say get emotionally attached to like the actual brand ethos and what you're trying to create as a whole. Because the most effective brands that we work with and have worked with and talked to, I go back to the word of like operationalizing the product testing and product launch pipeline, because really and truly what you're doing is you don't want to take like the actual passion and emotion out of it, but you're trying to figure out things that will actually work for the brand, and a lot of them will fail, and just obviously don't get discouraged on that. And that's where it gets into obviously what we were talking about before, is actually de-risking that financially to make sure that you don't actually go to bat with something too big before you figure out if it works. So one thing to hit on there, we haven't really talked about the softer side of e-com, but not to really get too emotionally attached to the products that you're developing.
Yeah, for sure. I mean, it's like that saying, right? Like winners have failed more times than losers have tried. But it's like, if you think about how do you build a winning brand, it's like, well, you just got to try stuff. And you need to like be comfortable with the fact that like a lot of your ideas may not actually work. So therefore, have a strategy that doesn't knock you out if it doesn't work. And that all comes down with risk. And that's why, again, like you made this point really early in the call, it's like, what's the risk adjusted return of every single kind of, you're placing of every single launch you're doing? Because you're underwriting a certain amount of risk across your different types of products. Like, especially right now, like one discussion with tariff uncertainty, things like that, is like, which part of your catalog are you actually going to consider reordering, and which are you just going to like try to convert as much of it back into working capital and potentially consider different things to put that working capital into, i.e. the products that are already winning, or the products where maybe you can have a certain supply chain advantage, et cetera. Like those are also things that are being talked about right now with brands, where it's like, okay, you have this really big catalog, but you already know there's an 80-20 in terms of where the revenue is actually coming from. And it's 20% of your products. I love this. Like every time we look at this with a brand, we do this analysis called product mix. It's very simple. How many units are you selling in total? And then what percentage by SKU do they represent of your total? And every time, without fail, you just highlight the top 20 SKUs and you do a percentage on the, if you're looking at it in Excel, without fail, it's always 80-20. 80% of your revenue is almost always coming from 20% of your catalog. So then you have to ask yourself, well, what do you do with the other 80%? And the answer is like, well, consider cycling out of it, especially now if you're already going to have to take an increased tariff burden on it. Just like consider like, is this a product that I'm actually going to reorder, or am I going to place a new bet?
Just because you have it and you move units doesn't mean you have to keep it. Like that's a good concept too, right? Like just because it's selling doesn't mean it's something that you actually have to keep reordering.
Yeah, and my favorite visualization for this is like, you have a warehouse full of duffel bags of cash, except they're not duffel bags of cash. They're literally products on shelves that you need to go and free up. Like if you want to do a fun analysis that doesn't take that long, go look at the products that have had 0 sales in the last 30 days against how much inventory, like what percentage of your balance sheet in terms of your inventory account they make up. For example, like, are you sitting on a lot of products that you actually haven't sold recently, or like have had a very small, almost meaningless impact on your revenue, but you're sitting on like a pretty heavy percentage of your overall inventory that's just like, by definition, not productive products? Like that's another way to kind of gauge it. And again, there's seasonality, right? Like some products you do actually have to sit on, but especially going back, if you're in clothing and apparel, like, and maybe CPG as well, but CPG tends to, let's just say, depends on the category, of course, right? But if you're in clothing and apparel, and you're sitting on highly seasonal SKUs, ask yourself, do you want to sit on those? Because if you don't sell them now, you might have to wait another 6 months before you can sell them again. Like, for example, if you're selling like outerwear, that makes a lot of sense in the winter. Like, well, do you want to sit with that outerwear in your warehouse with that working capital tied up until the next season that you can actually sell that? A lot of the times you're actually more incentivized to get as much working capital out of that inventory as possible and then reinvest in the stuff that's actually going to make sense for the season that you're going into. And that's, again, where you want to be really tactical about what are you doing on the marketing timeline side? How are you planning these different kind of merchandising periods, the sale periods, the seasonal moments throughout the year? Do you have a strategy for a lot of this inventory that otherwise would be unproductive or will be unproductive over the coming months? Do you have an understanding for the different categories of your business and how that seasonality works? And then are you taking action on the returning customer side, on the new customer side, to move those units as effectively as possible? Because really, again, you're just trying to convert that back into working capital to go and place other bets or double down on the winners that are already working. And I think especially now, when it comes to catalog sizing, And looking at that 80/20, I think a lot of brands are going to say, I'm taking some chips off the table. I don't want to reorder these products. I know are not productive products. This is not working capital that's serving me right now. I'm going to try to move out of these products at some contribution margin. And I'm going to try to take that cash back into my business and just double down on my A-grade inventory that I know is selling. The hero stuff that it's like, whether I discount it or not, we'll move units. It's just a matter of how many units we'll move. So I think that's like a really big discussion we're having right now, just internally with brands.
Absolutely. And I also think, and this is a bit of a different, not different topic, but kind of a different topic within this topic, is like the best thing I think you could do as a founder, operator, somebody running a brand for your marketing team or for your agency, if you're working internally or externally, is launch new products consistently. Because that, again, like when you get into discussions about how do you actually move the needle on the marketing side of things and growth strategy, again, creative is huge, copy is huge, account strategy is huge, marketing calendar is huge. All of that is, has massive impacts. But fundamentally, that's all centered around what you're actually selling. That's the core of what everything is. So when you talk about how to actually give like gas for your marketing team or agency to actually like put on the fire, that is basically product. Like that is the biggest thing that you can give them to actually move the needle and grow the business long term, is a consistent stream of new products. Because that, again, is like what we're saying, like all of it is structured around the product. We're selling products at the end of the day. So that's also something I think that does get overlooked too. Just when it comes to growth marketing and strategy as a whole, like product launch strategy and the product pipeline plays a massive role into that. Kind of an obvious statement, but something that I think is actually not really focused on enough. It's something people will always be like, oh, we need more creative, we need more assets. Yes, absolutely, that's going to help. But also different products to test and trial is going to be a big thing as well.
100%. As we get close to the end of the episode here, maybe we can go through really quickly, like what are some ways that from a channel perspective, brands can kind of move units, move products, launch products, things like that. Obviously, we talk a lot about email, SMS, direct mail. Like these are all fantastic channels. Obviously, when it comes to the ad side, site merchandising, how you're optimizing, where your traffic's going, like what are you recommending on PDP? How are your actual, like, let's say buy boxes built? How are you displaying the offer? How are you, again, merchandising across the site? What's your pop-up and opt-in strategy, et cetera? There's a lot of these tactical things. So maybe we can spend a few minutes as we kind of get close to the end of the episode on some of those tactics. I guess, Liam, from your perspective, when you chat with brands, what are some of the main things that they're maybe overlooking in their either acquisition or retention strategies? Like what's a big blind spot that all brands should just like kind of redial in on?
Well, I'd say the first one on acquisition is kind of an obvious one we've talked about a lot, is just making sure that you're not necessarily spending ad dollars on something that's completely new that you haven't tested before without maybe trialing it to your existing audience first to begin with. We touched on that a bunch to the presentation. It's a fairly obvious thing to do, but it's something that easily does get overlooked because, again, it goes back to the kind of premise that oftentimes people won't look at product and their product catalog broken out between acquisition and retention products. So if you're not looking at your product catalog like that, you might have the inclination or the intention originally with a new product that you developed to just launch not ads right away and put spend behind it. And a very simple concept that everybody's well aware of in the DTC space is if you're taking ad dollars and spending it on something new, whether that's a new channel, whether that's a new creative, whether that's a new, maybe creative, kind of maybe not in this discussion, but new channel, new product, etc., you're risking ad dollars on something that you have no idea if it's going to work or not. And if those ad dollars were put behind what's working right now, obviously you're going to see the returns that you are consistently seeing. So it's a risk. So I think that is probably the single biggest thing. I think just in terms of like, how do you look at launching products on acquisition retention? The first thing is like just de-risk it, test it on a channel like retention. If that gains traction, okay, maybe let's try it on acquisition and kind of go from there, as opposed to risking dollars behind things that you really don't have any idea if they're going to work or not. Time and a place for that, but generally speaking, that's probably the main one.
Yeah, 100%. So that's not to say like hide it on site, don't make it discoverable. Yeah. It's just more so like, do you really want to double down on this at this point in time before it's actually proven? I think from my side, like one thing that we often see with brands, even fairly mature ones, is just the site merchandising that gets overlooked, or the discount strategies on site
100%.
Where the products that are being surfaced in recommendations, like they're not really the products that you necessarily should be surfacing. And what do I mean by that? There are certain places where I mean, in your post-purchase upsells, in your cart upsells, in your checkout upsells, in your, like, let's say you're sending a lot of traffic to your homepage, or, it's going to PDP, like, how are you merchandising those pages as well? And from that perspective, it's an exercise of looking at, okay, what's complementary? What is actually makes sense to logically sell there? And that kind of goes back to our discussion of like, someone's in market for hats, like probably just show them hats, right? Don't try to cross sell at that moment. But there's also like, if we're talking about a post-purchase upsell, for example, or an in-cart upsell, or just trying to drive up some sort of incremental cart value, maybe those are good placements for products that you actually just want to get rid of and are able to discount highly because they're just adding more padding in terms of cart values.
And a good way to look at that too, Jacob, not to interrupt, like anything that's like, if you're placing those products that you want to have, and let's say for the discussion, we'll call it like C products, things that you just want to move, you just want to get out of here, like they haven't worked, you just need to move them, they're taking up space, like just get them out the door. If you have that anywhere, but obviously you'll have it on your site in your catalog, but like if they're in the main inventory areas within your site, like that is taking up very precious inventory of things that could be moving units at a much higher margin that are actually working. And when you place it there, like that is a huge risk to the business and taking away, a lot of potential gains from having products there that are in your A category, for example. So a good concept is like anything post-purchase, whether it's the upsells, etc., after somebody's actually completed a purchase in that process, like they've already bought from you. They've already put their credit card information in. Like just throw stuff up there that you want to move and you want to get out the door. Obviously there needs to be intention behind it because that's a very high intent time frame for that customer. Like they've bought something from you. So if there's something there that complements that or they might like, then obviously that boosts AOV and that helps with everything when it comes to growing the business. So it's not something where you just want to throw random products up there. But at that point, you have their credit card, they have bought from you. So it's much easier there to actually put something that you just want to move and get out the door, as opposed to taking up precious inventory within your PDPs or within your product catalog pages, etc.
100%. I couldn't agree with that more. And it comes down to like also when you're doing your site testing, like what do you actually prioritize from a CRO perspective? It's like, these are the things you need to prioritize. Like it's not button colors. It's not, like layout testing 100%, like there's a time and a place, but like your merchandising on site, like where you're placing products, how you're recommending them at different parts of the journey, that's very important from either a profit per session standpoint, from a AOV versus conversion. Like the one thing you don't want to do is just say, all right, we're going to maximize AOV, but in the process, you actually derail the customer and you basically recommend products that have no real like sense. Exactly. And it only hurts conversion, and AOV does improve, but the overall volume drops. So there's like a really careful 100%. Kind of process that you want to follow 100%. There. And then to your point, post-purchase, like that's a great place where the order has been placed. The only thing that's happening right now is there's like this 2-minute window that the system's giving. In this case, like in Shopify, you have this order on a hold basically, where you can still actually edit it. So the order's already been placed, and the post-purchase upsell is just a decision that customer's making at that point. Okay, there's this product that's 40% off. Wow, like sure, I'll just add it right now. Or, I'll subscribe and get 20% off if I make this product that I just bought a subscription product after all. Yeah. So there's a lot of these little tricks and strategies. And I think the last thing I'll say too is like discounting is like being really intentional about how you're discounting. Because we see a lot of merchants that discount their hero products way too heavily and don't discount their kind of C grade products, let's say, at all, or not heavily enough, And it's just this like, again, it comes back to merchandising, comes back to discount strategy, but these like flat discounts where you're willing to offer the same discount on like literally your best products, the hero products, versus the products that are already unpopular, no one's buying. You don't want to be treating those products as the same thing. And there are very different objectives there. And again, going back to whether it's an acquisition SKU or a retention SKU, how you treat it, how you merchandise it, how you discount it, it all matters. Mm-hmm. So having those conversations with your marketing teams and also with your ops and finance teams is important so that you understand like what is the value and the expected ROIC on each product that you have in your catalog and each new bet that you're making from a PO standpoint.
Mm-hmm. 100%. I think we covered a lot there. A lot of good stuff.
Awesome. I think that's the episode, man.
Awesome.
Thanks, Lynn.
Yeah, thanks, Jacob.